Edward Moya is Chief Market Strategist at Marketpulse and OANDA. Edward, thank you so much for having us these minutes.
Thank you for having me.
Edward, U.S. consumer prices rose sharply in September despite Federal Reserve rate increases. Core inflation climbed at a 40-year high. Can we talk about Fed's failure?
Well, it's pretty clear that the Fed is very disappointed with this report. Core inflation is what is needed to show some signs of easing, and right now it's still very hot. And you're going to see that this is going to force the Fed to remain aggressive, not just in November, but also in December. And that's probably going to complicate investors' appetite for risk over these next few months. And I think what's really difficult for the Fed is that you have too many key components that are not providing us any optimism that we're going to get that inflation relief anytime soon. Core CPI, 40% of that is coming from rents, and shelter prices are still stubbornly high, and they rose 0.7%. And I think you're going to see that you're not going to see that come down anytime soon, and I think that's really going to complicate all these Fed pivot calls. So I think the Fed is going to have to remain aggressive. They were late to fight inflation, and they're going to probably have to be aggressive, not just in December, but I think people were expecting them to be done tightening in December. They're probably going to have to also raise rates in February as well.
Edward, if we talk about the next monetary policy meetings, Barclays is talking about 75 basis points for next two reunions. Could the Fed bet on a hike of 100 basis points?
They missed the window to do, I think, 100 basis points. I mean, they've done it a few times now at 75, and I think they're going to have to stick to that pace. The report, while I think the headline numbers, and I think most people are going to call this a hot inflation report, there are still signs that inflation is heading in the right direction. So I think they're going to stick to the script, because right now the Fed is in a position where they have to tighten until something breaks, and whether that's financial instability or if we see some other catalyst. But right now the Fed is pretty much locked into an aggressive rate hiking cycle, and I don't think they want to raise it a little bit, raise that pace to 100 basis points, just because there are other global market risks. We don't know exactly what's going to happen with the gilt markets in the next 24 hours. You're seeing the calls for more intervention from the Bank of Japan are probably going to happen at some point. So I think the Fed needs to see exactly what happens to financial stability in these next few weeks leading up to the Fed meeting. But I think 75 is probably what was priced in before this report, and I think this pretty much cements that it'll be 75 at the next meeting.
And one of the main questions now is where is the limit of these rate hikes?
Well, it's hard to imagine that a lot of people were not convinced we were going to see 5%, and I think that we're probably looking at 75 in November. The hope was that we were going to get a half point, a downshift for the December meeting. That is in question right now. So I think there's a good chance you could see 150 basis point in rate hikes by the end of the year, and a lot can happen between now and the February meeting, but I still anticipate they're going to have to remain in tightening mode, and that you probably will see either a downshift to 50 or best case scenario only 25, and then maybe we'll see a pause. So I think that's still a significant amount of tightening that's going to be happening, and that'll probably take us at 5% or higher.
And if the Fed remains in tightening, what does it mean for equity markets?
Well, equity markets have been close to pricing all this tightening in. I think you're still looking for downside risks here. I think earnings season is not going to be too optimistic, but the health of the consumer is probably going to come into question. I think what we're going to realize is that we really have a tale of two economies. I think manufacturing, the housing markets are in a recession, whereas the service sector is still strong, and that's what's complicating things. I think you really need to see weakness in the service sector to really, I think, spur those Fed pivot calls. So I think we're still looking at downside. Whether stocks fall another 5 or 10%, that's probably what a lot of people are anticipating. I think the risks are still for downside, but I think we're probably going to see that Fed pivot get somehow priced in, I think, over these next couple of months. So I think investors need to be cautious, but right now I think we're getting close to, I think, the end of the selling pressure.
And for next year, for 2023, do we rule out interest rate cuts from the Fed?
I think the Fed is going to try to be very clear in signaling that once they're done hiking, they're going to keep rates elevated, that they're prepared for a recession, and they're prepared to keep monetary policy steady. So they're going to do their best to signal that no rate cuts are coming. I think Wall Street will, doubt that, and they'll probably start to price in something possibly third quarter or fourth. But I think there's still there are too many variables at play, and I think right now there's the risks of stagflation are still there, and the Fed needs to make sure that this inflation problem isn't dragged out for years. So I think they're going to remain fairly aggressive. I think that we'll see that get priced in probably before the end of the year, and hopefully we start to see the economy show signs of weakness, and then that will really provide some optimism that inflation is coming down.
And meanwhile, the IMF's director, Kristalina Georgieva, has said that the risk of global recession is now 25%. Do you think this is accurate? It's a probability that we believe in?
I think there are large parts of the global economy that are going to hit or have a recession. I think Europe is pretty much a done deal. What we're also seeing happen in China is rather surprising. I mean, we're so used to seeing robust growth from China. I think things are going to start to improve, and I think 2023 will be a much better year for them. But I think you're looking at. I think a coin flip whether or not the U.S. has a recession right now. I think it won't be a severe one. At least that's the way it looks like inflation will start to ease, and that will allow the impact of these Fed rate hikes are going to be really felt next year. And I think that you'll probably see that we will have 2 negative quarters of growth, or contraction that is, and also that the unemployment rate will tick higher. I think that we'll probably get that first negative non-farm payroll report in the next couple of months. But right now, I think this market should prepare for large parts of the global economy to weaken, but a complete global recession, that's still not the base case.
Edward Moya, thank you so much for having us these few minutes.
Thank you.